Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, November 19th, 2018. As we head into the Thanksgiving holiday week here, keep in mind for you U.S. traders, the markets, of course, are closed on Thanksgiving. That's this Thursday. And then we have an abbreviated trading session on Friday, I believe 1 p.m. close, if I'm not mistaken there. So typically, this is a light volume trading week, and somebody brought something up in the trading room today. Said, a lot of traders expect this week to be up. And I get this put to me a lot about seasonality. I think traders put way too much effort or focus into seasonality, and because of that, my reply was, vast majority of the time, you go back 100 years, look at a chart, stocks usually go up, and they will over time. The stock market goes up over time. That's one guarantee that you have, pretty much as close as a guarantee. But when you zoom into the shorter term time frames, you see there are bear markets and corrections within the bigger uptrend. So when it comes to seasonality, and they give any given week, take Thanksgiving week, for example, and I don't honestly know what the stats are. I don't care because the charts will affect most likely what's going to happen that week. In other words, if 9 out of 10 times or more, I'd say easily over 90% of the time stock market's going up, you're going to have most weeks, or maybe it's not 90%, but it's a lot close. It's much over 50%. You're going to have most statistics being bullish during seasonality periods. But anyways, again, what's going on now, especially when there's pretty strong market action in any one direction. Everything has been bearish lately. The charts are bearish, so therefore you're probably going to have at least so far today. I mean, they're going to have to do a big reversal. Right now, QQQ is down over 3%, SPY is down almost 2. So far we're off to a bearish start for the week, but we'll see. I want to caution this that from my experience, this is a tough week as you get into the week, as you get closer to the Thanksgiving holiday. Traders start checking out on Wednesday and heading to wherever they're going to head for the holidays, and hardly anybody's around on Friday. Low volume makes it a field day for the market makers to run stops, and just from my experience, you tend to get a lot more false breakouts and whipsaw signals the week of Thanksgiving. Now, volume should be high today. Usually, volume on a big selling day like this is high, so that's going to skew that figure there. But again, I wouldn't put too much into seasonal. Just trade the charts as they come. And if there wasn't anything in the charts, if the charts were ambiguous right now as to the near-term direction of the markets, then you maybe factor in that seasonality play. All right, so enough on that. Let's take a look at, let's start with the futures, and to do that, let's take a look at what I posted on the site this morning. Right side of the chart. Before the market opened today, I posted a couple charts, and I also shared some charts that I posted on Friday afternoon in the trading room. Let's start there. So this is bearish divergences on stock futures playing out. So this first chart was from Friday. You can see that was about a half hour before the market closed. And if you recall, most recently I'd pointed out these bullish divergences here. We had a divergent low, which was bullish. We broke a trend line, went down, back tested, and then I had highlighted here. Again, this is Friday's chart that we were set up in a bearish rising wedge patterns, complete with, yes, you got it, there it is, negative divergence, what I like to see. So I showed a scenario that the rally also stalled right up around this 2750-ish level. It's resistance. And so again, that was Friday's chart. And this was posted this morning saying that, we did break down from that wedge and look like we're headed lower. And let's take a look at where we are right now. This is the updated chart. So there it is. So, that's a good thing about corrections. When there's a lot of selling in the market, technical analysis, in my opinion, works so well. That's what traders are flocking to. They're not. Somebody in the trading room made mention they were watching CNBC, and everybody's screaming at each other over Apple. Everybody loves Apple. Apple's a cult stock, and it's a great company, great products. But guess what? Fundamentals don't matter during a strong market sell-off when you have forced redemptions, liquidations, stops being hit. Technical analysis is where it's at. And so, charts in Apple were bearish and the market was bearish, and we're getting that unwinding of the FANG bubble. So it doesn't matter how profitable Apple is, what their PE ratio is, or anything else going on. It's just there's and of course there's some headlines will follow the charts. I think the iPhone sales, somebody put that they some downward revisions, but let's not get into that again. The fundamentals, the news will follow. You'll notice this when the market's in a strong uptrend. Good news is good news, and bad news is good news. It's just dismissed. And when the trend changes and the market action is bearish, all news is bad news. Good news gets ignored. Bad news is bad news on face value, trade wars, whatever it is. So there it is. Anyway, so ES is playing out now. Let's talk about what's going to happen going forward. We had a pretty decent support here. The last decent near-term support level at about 26.95, 26.96. We're cracking below that, not with a conviction yet. I mean, keep in mind, we're pretty oversold. We're down on the SPY. These are ES futures. You can see down here, we're down almost 2%. The SPY's down a little less. Remember, the futures get a head start. They're trading virtually around the clock. And again, I like to use the futures charts because I can pick up a lot of developments that the SPY, which only trades 9:30 to 4 p.m. regular session, you're going to see those trades, whereas you have round-the-clock trading on ES. So there it is. That's a pretty key level. Is a stick save possible? It is, but I don't think we're going to get it. This is, I think, that point where we're going to come down here and we start to hit more and more stops, more and more longs that bought, of course, the longs that bought this rally here, they've all been, almost all of that's been faded. They bought this breakout, and this shows you the character of this market. 3 months ago, 6 months ago, a year ago, you get a divergent low on the 60-minute chart like this, buy with both fists because we're going to go up and do more than 100% retracement. That's usually where we went on and poked on or punched up to new highs. But in this market, you can see we're getting these divergences. They are playing out, but they're playing out to the lower end of what one might expect. And here's another example. We had a little, we'll call it a little baby divergent high, a little small bearish wedge, which was much smaller than the preceding. This was more of a price channel, and Q had a wedge, and you see much more impulsive selling because that's the bear trend. So here it is. Those are the levels to watch. I'll lower that line right now since we sliced through it, and it comes in. If you notice here, it captures some of those recent reaction lows a little better. So futures traders, let's watch where we're at right now. I can't call it the last hope because there are other support levels. Reaction lows are natural support levels. You have a reaction low there, but you only had that one reaction. I don't put a lot of stock into that reaction low. I can't explain it. That's, to me, I wouldn't put a lot of stock. Some I put higher weighting on. Then we have a cluster of lows here. That was the low back on October 29th right here, but there's more of a cluster there. So in other words, what I'm getting at, support gets pretty darn thin below here if we take out this level. So if there's any chance, we'll stick save it today. And again, that's not my preferred scenario, but I'll respect it. They need to defend this level here, I think. And, if they pop below it and then regain it. But market action's ugly right now. And what I think is going on is more the bigger picture I talked about for the last few weeks here. Predicted this would happen. Selling begets more selling. This was a correction that was first and foremost built into the charts. It was built on technicals, and as the technicals broke, stocks fell, and then you're getting the unwinding of that FANG bubble. Let's look at another chart. Let's look at NQ for a second here. Okay, again, the post on the front page or right side of the chart this morning, and these were public charts, by the way. This is just general market analysis. It's not trade ideas or sector analysis or anything reserved for paying members. You can come and check these out. You click on that to expand, and once the charts are expanded, you can zoom. If you have a scroll wheel on your mouse, you can pan them around, take a look at whatever you want. So again, this was from Friday, posted in the trading room about half an hour before the close, showing you that we had divergence. There was the flat line. You look at that white line there and show that would go. And at most, I had it, if we popped up a little higher into the close. But again, you can see here on my notes, I was expecting a late day sell-off in the final 20 minutes of trading. And that was Friday's chart. This was today. We did sell down on Friday. We got a little pop in the overnight futures, and that's what happens a lot lately. They're stopping pops in the overnight sessions in the futures, and then put in that divergent high. See a slightly marginal high, so it gave us really, actually, I like this better because it put in a clean divergent high. Before we were just a hair shy on Friday. So there it is. I already showed you this. ES had divergence on the 60-minute, and now you can see it on NQ, and that was again this morning's chart. Posted about 9 in the morning, a little before the market opened, about a half hour or so. And where we're at today or right now, this is what happens, and this is how these divergences play out when you're in a mode of distribution. That's the bottom line right now. The market's in a distribution phase. And so let's talk about that real quick, and then I'll go to the daily charts and give you some long-term levels and potential targets to watch. Okay, one of the members in the trading room posted a link over to Zero Hedge, but it actually linked to, I know tonight I've guest blogged on here, guest posted. It's been a while, but great. Tim he's a Bears bear. If you know Tim Knight and Slope, I hope this is from his site. So he picked up something that happened recently and posted an article. And I'll let you read it again, slopehope.com, and I posted it about 19 hours ago. One fund's instant destruction. It goes on to talk about. He always does a good write up. Talks about a website, and this guy was trading, optionsellers.com, and then went on to open his own fund, and his fund blew up. By blowing up, it means gone, poof, kaput. He was, I can imagine, short natural gas. Who knows, long natural gas has just been choppy as hell lately. I get a lot of comments or inquiries about it in the trading room, and I said that you can't make heads or tails of the charts. What's going on with natural gas here? And I'm leading into what's going on in the stock market with this, by the way, is you had a huge move in natural gas, huge spike up, followed by a huge reversal. It's been very volatile lately. And what happens, especially with traders that are trading on leverage, I mean, futures in themselves are leveraged. Nat gas, I think the leverage factor is what is it? Like 10,000 or whatever. It's highly leveraged, not leverage factor. I'm sorry, that's the multiplier on the futures contract. But if you're using options or even the leverage ETNs, a lot of people trading these, and you can actually lose more than your total equity in your account that you have on the position. That's what's happened here. And you go on, it talks about he had to send a letter out to his clients, a catastrophic loss. What happens? A broker takes over. They blew the fund up. The broker is forced liquidations, and they're actually doing that now, liquidating this fund, and the site's down and everything else. It's now here's the thing. I've mentioned that recently is a what I believe to be a likely scenario coming up in the market. I went over this in detail before, showing you how stocks have fallen. It's an unusual time, a rare time in the markets where stocks have been falling, the S&P 500, QQQ, everything else, but along with it, a lot of risk-on assets like treasury bonds have been falling until recently. And I can't go into this one. We have a long position in this one right now. Treasury bonds, oil, crude oil. Funds were extremely long and bullish right up here at the highs recently. And look at this meltdown. We haven't seen a drop like that in years in crude. And where I'm going with this is, yes, what does oil or natural gas have to do with the stock market? Actually, more than you think. The same funds. Now, I don't know what that fund had that Tim Knight was focusing on, but there are a lot of funds out there, hedge funds, for example, and that may be one of their positions. They might have been long or short natural gas, long crude oil. And what happens when you have these very sharp moves, both individual investors who are, maxed out on margin. I already went over in several videos the margin bubble and showing you that's at coming off historical highs recently. You get the unwinding of that credit bubble, the margin bubble, forced margin calls, selling begets more selling, and again with stocks falling, oil prices collapsing, and the usual safe haven assets, gold just kind of lingering in there. It's moving up. We also have positions in gold, silver, or gold, platinum, and some other precious metals. We have a lot of defensive issues right now, and they're all profitable, all doing well, but the point is, gold's not going up as much as it might normally, and treasury. So there's really, like I said, no place to hide. So what I'm seeing, and it kind of goes back to that fund blowing up where the broker then steps in and liquidates positions. They give more margin calls. We may still get more of that. I think that's a large part of what's going on now. Again, I talked about how pension funds and a lot of institutions are underfunded. The pension funds are, and they're also too top heavy, in my opinion, equity, and they're too top heavy, particularly in the FANG stocks. That's why we can continue to see QQQ outperform to the downside, or underperform, if you want to call it that way, down 3% with the S&P 500, a SPY down only about 1.82 right now, and that is them forced selling in all those market-leading FANG stocks: Apple, Microsoft, Amazon, Alphabet, Facebook. They're what I call the FAMs, FAAMG, and here's what may happen now with these funds blowing up, and I would not be surprised. I've said it before, to see in the headlines in the next coming weeks here, to see additional funds blowing up, and if that happens, brokers are at risk. If a fund is over leveraged and their equity is instantly wiped out. If they're in a, if a position moves more than expected, like that drop in crude oil and that spike in natural gas, that can move so fast that the account holder's equity is wiped out, and that's what happened in that fund. And then it actually goes into the broker, and the account holder's on the hook for it, but the broker has to recover that from the client from assets they don't have securitized anymore. In other words, that's how a margin account works. Put in money, what you have in there, it secures your loan to borrow more money to invest. And again, if that loan's wiped out, then you're underwater, and the broker's on hook. So where I'm going with this is, and I've seen it before. I've seen this happen in 2008. I even believe I saw it happen in 2015. The brokers will often increase margin requirements to protect their own arse, let's say. So to cover their own butt, they will raise margin requirements. What does that mean? As I talked about before with the margin bubble, people aren't chock full of QQQ short or NQ short. There's certainly some out there, but as I said, short interest on any stock, just about any stock, particularly on the broad indexes, is always a small fraction, a mere fraction of the long positions in the market. So when the margin bubble is high, most traders are invested long, especially at the end of a bull market or near the top of a bull market. That's just a given. So therefore, if margin is reduced at the brokers, they all of a sudden change the margin requirements. What happens is, well, now you have force margin. If you're already on the verge of getting a margin call, you're going to get one now. So selling then begets more selling. You have to reduce more of your long positions, which means sell them. That selling causes prices to go down, which further contracts it, and it's a vicious cycle. So are we in that now? I think that's a part of it, but I want to again caution um, the risk for a swift and sudden sell-off if that happens. In other words, if just everybody starts selling at once, the brokers hunker down, pull in their margin, allotment, or allowance to a lot of funds and individuals, and they're forced to sell. And if so, we could get a nice swoon down. And again, I won't, members of the site, we have an official trade on QQQ, so I won't give exact targets. But let's say somewhere close around there. But my targets are dynamic because the market is dynamic and the charts are. So it's possible that I may tighten up my targets, close that QQQ trade out early, maybe even reverse it and go long if I see something compelling, or even extend it. That's a possibility too. So that's what we're looking at right now. And I just want to make this clear, and we'll wrap the video up, keep it kind of short. I don't see much in the charts really. From looking at the daily charts and the intraday charts that indicate a strong likelihood for a bounce. So right now I'm still looking at more of the same. And the fact that we are playing out like this, it only now increases. Last week I was a little cautious because we had those 60-minute divergences. I wanted to see how much they played out for, but again, come late Friday, I was already looking for a reversal there, and that's what's happened. So now, again, I don't see a whole lot keeping us from going through my scenario here. We have another flush out move, maybe put in a divergent low in the next probably a couple weeks. It's hard to say time wise, but we'll see. If all that starts to play out, and again the selling begets more selling, it can happen pretty fast. So that's the good news for those that are long and trying to ride this thing out, that the end may be in sight, because usually you get those flush out moves towards the end of a corrective phase like this. QQQ, I do want to mention this, is at support on the 60-minute chart. So again, I just showed you earlier on ES, if they want to save it, I showed you the ES was at support. That's the S&P 500 futures. QQQ, I have the support level here at 162.20. Not a whole lot below that, I will say that. We can go down, certainly, here, if you can make it out. There's the reaction low from back in October 29th, but I see more reactions here. So this is a level that QQQ needs to hold. And on the 60-minute chart, if they do hold it, we'll have divergence here on the 60-minute chart of QQQ. That's also a low-level backtest of that wedge, actually, as I extend that downtrend line. So there it is. Bulls can fight for this, maybe reverse it here. But overall, again, I don't like where we're at for the bullish case. I mean, position short, I'm happy with that. But as far as a case for a bounce, You can see now this is pretty significant resistance. This is where we failed here, 168.67. In case I don't get another video out or an update, if we do bounce, that will be formidable resistance. Proved to stop this last advance, and it has a lot of reactions there. So let's just look at that. Of course, there's a level there that we gave way today. I think I mentioned that last week, 166. So now it's a matter of defending this support. If we break that, there's just not a lot below. I think we get a waterfall sell-off. I don't know if this whole Thanksgiving week will delay or undo some of the bearish technicals in the charts. Anything is possible. So let's just, again, let's not try to second guess everything because it is Thanksgiving week. There's SPY back testing this downtrend line here with some potential divergences in place on the 60-minute chart. PPO just crossed bullish. It would need to turn back up, but there's potential divergence and sort of a last ditch support level for SPY if it goes any lower. Again, I don't have high hopes it'll hold this, but 263.44. Again, that's a little above the October 29th reaction low, but I see a few more reactions there. So let's look at that level. Those are things to watch. But otherwise, I think if and as we move lower from here, again, if we take out today's lows, we're off those lows a little bit. Here's a 1-minute chart of SPY. If and as we move lower, I think it will then trigger additional selling, maybe get a little waterfall type sell off. And we could be looking at an end to this correction if that happens relatively soon. Maybe doubt anything will happen this week, maybe, but I would say maybe look into next week or the following week, probably the week after Thanksgiving, because again, things usually happen quick at this point. That's my experience as far as these corrections and sell-offs. We already have had now a couple WTF moments, and now I think we'll just get that last thrust down and start to look to set up, close out some shorts and maybe look to go long. On that, just so you know, we'll see how the charts look. Again, I always say that charts are dynamic, and so is my analysis. But it might be more of a second mouse thing on the long side, where there's a second mouse gets the cheese. So sometimes, and quite often, I do, nail the bottoms on these moves down if a well-defined target's hit. My target area is a little fuzzier this time. If anything changes, I'll let you know. So whereas I often close my shorts and reverse to long at the same time after a correction, this time around I may just scale out or close out short positions and then wait for some decent evidence of a bottom. And make sure, like I said, most importantly, that because I think there's that unwinding of a lot of positions for selling in both institutions and individuals. So you want to make sure that's out of the way before you try to step back in on the long side. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.